Welcome to Conversations with Frank Fabozzi. I'm Frank Fabozzi. My guest today is Dr. Mark Anson. Mark is well known in the industry. He's the CEO and CIO of the Common Fund and chairman of the board of Common Fund Capital Inc. and Common Fund Asset Management Company. Welcome, Mark, to our actual second Conversations with Frank Fabozzi. In this conversation, I want to discuss several themes that shape the work of a modern CIO. Are you ready?
Always ready, Frank, and thanks again. Always a pleasure to speak to you and talk through some of the current topics going on in the asset management industry.
Great. Well, let's start with geoeconomics, which refers to how powerful nations such as the United States and China use trade and finance to exert influence abroad. These tools include, as you know, export controls, tariff sanctions, and restrictions on strategic sectors like semiconductors or rare earths. With this rise of geoeconomics, how is the Common Fund positioning its portfolio to manage risk and capture opportunities?
Well, thank you, Frank. First off, there's an expression out there we're hearing more and more, and it's called the regionalized global economy. I love that statement because it's an oxymoron. Global means global. Region means a part of the global. So regionalized global economy, those two words, they'll really go together. It's an oxymoron. But the fact is, it's actually applicable to some of the issues we're looking at with regard to common fund portfolios and I'm sure other asset managers as well. And so, yes, to your question, we are increasingly focused on geographic regions. And let me give you one data point. We manage very large private equity and private capital portfolios for our clients. And we have always looked for buyout firms that have a specific industry or sector focus, such as healthcare or SaaS or franchise businesses. In fact, recently we've allocated to firms like that in the US. But at the same time, we're now starting to look for those same industry-specific focuses outside the US. So as an example, we just recently allocated capital to a private equity firm that does buyouts in the SaaS space, so SaaS, software as a service, in companies across the Nordics. So again, it's a regional focus on an industry sector, a region outside the US. And as we think about our private capital portfolios, we're looking more and more for managers and solutions that have not only that industry focus, but that region-specific focus. So yes, this is one consistent theme. I'll give you another one. We are big investors and committers of capital to artificial intelligence. So at Common Fund, we have direct equity stakes in ChatGPT, Anthropic, Hugging Face. Those are domestic companies here in the US. But recently, within the last month, we also committed capital directly to Mistral. That's an EU artificial platform based out of Paris, but meant to serve the European Union, the continent of Europe. So again, a specific focus, artificial intelligence, but with a regional application. So yes, it's becoming more and more important. And the last point I would make is we talk about supply chains. How are they going to operate in this regionalized global economy? And yes, there will be supply chain vulnerabilities as we go more towards a regionalized approach. What that means is supply chains are going to have to duplicate themselves. And when you have duplication, bluntly, that means higher cost of production, which leads to lower profit margins and then lower EBITDA or cash flows. What does that mean for us as investors in the public markets? It means that the stock markets are going to have to adjust and allow for higher price to earnings multiples, or stock market valuations are going to have to come down to be consistent with lower profit margins. It's going to have to be one or the other. So let me stop there. That was a bundle of thoughts to get back to this oxymoron of the regional global economy.
Well, yeah, I eliminated that aspect of it in the question because it did seem like an oxymoron. To what extent do these geoeconomic dynamics affect your long-term asset allocation framework? For example, the balance between, let's say, global equities, private markets, and real assets.
Yeah, it's becoming increasingly not difficult, but certainly challenging. Let me give you one asset class where the impact I think will be the greatest. When we look across our asset allocation, we do stocks and bonds and private capital and private credit and real estate, et cetera. The one asset class that is affected most by economic regions or global regions or economic geographic regions is real estate. Real estate values are distinctly affected by local laws, population trends, employment statistics in that region, building codes, occupancy rates, etc. So more regionalization will drive more idiosyncratic risk associated with a global real estate portfolio. And we've been very finely attuned to this the last, I'd say, 4 or 5 years, looking at how the overall pieces of our global real estate portfolio fit together and what are the regional trends that may offer opportunities or maybe additional risks. I'll give you another demonstration. If we just look at macroeconomic policies, we see the Bank of Japan taking a harder line, a more hawkish stance in terms of raising rates. At the same time, it looks like the Fed's going to cut rates here in the U.S. this week. And certainly the ECB, the European Central Bank, is cutting rates as well. So you now see divergence of global macroeconomic policies across the G7, the G10, or the G20. Again, that opens up opportunities, but also creates new risks.
Well, do you see the need to rethink geographic diversification? Maybe you should favor regional exposures or tilt assets that are less vulnerable to sanctions, tariffs, or supply chain disruptions.
Well, my gosh, it's hard to find a country right now that is not vulnerable to sanctions, tariffs, or supply chain disruptions. So I think that's one that every country is sorting through in light of the trade wars going on. And not trying to sound too political, it's just the reality of the economic environment in which we operate. But what's interesting about this, and it builds on the point I was making a moment ago, when you think of globalization, what that meant is more trade networks really coming together and being more integrated. Now, we're seeing less of that, but in the past, if you think about it, used to talk about the G7, the 7 largest industrialized countries in the world. And then it became the G10, and then the G15, and then the G20. What that simply meant is these large industrial countries, the G20, were synchronizing both their macroeconomic fiscal policy and their macroeconomic monetary policy more and more. Well, now we're seeing less of that. And that opens up and offers the opportunity for more diversification. So as a data point, if you look past the past 20 years, the correlation coefficient between the S&P 500 stock market and the MSCI ACWI, All Country World Index, that got to be about 0.95. And if you looked at the S&P 500 versus MSCI World, which is developed countries outside the U.S., that correlation coefficient was even higher. So bottom line, you weren't getting much diversification anymore by investing across geographic borders. 20 plus years ago, yes. Just investing outside the U.S. brought you a lot of diversification. Over the last 20 years, very little. But now, back to this regional global economy, that's offering up more opportunity for diversification. So I would not be surprised to see that correlation coefficient between the U.S. and MSCI ACWI or MSCI All World begin to decline, and demonstrating that there is a bit more opportunity to diversify your portfolio just by investing outside the borders of your home country. So again, if we think this regionalization will continue, it can lead to better diversification benefits, certainly in the public markets.
Let's move on to private markets. They've grown dramatically as institutions seek return and diversification beyond the traditional public equities and bonds. Yet there are concerns about valuation practices, liquidity risk, and the sheer weight of capital chasing similar opportunities. Okay, from your perspective, how should institutional investors approach private markets today balancing, let's say, the long-term benefits with the risks of crowding and certainly reduce liquidity and transparency.
Well, it's a concern for us too. Every investor who's in the private capital markets, shares those concerns. And indeed, we've seen some of the largest, best known endowments and foundations selling off pieces of their private capital portfolio over the last 12 months. So clearly there's some rebalancing going on as well in well-known institutional portfolios. So let me give you a couple data points. Today, in the United States, there's approximately 4,600 private equity firms. Let's just, again, 4,600 private equity firms just in the US. If you go back to 1980, there are only about 20. So there's been an explosive growth of these firms trying to invest in private capital. Now, what's also fascinating is when you look at the number of public stocks in the US markets, it's about the same as the number of private equity firms. So we've seen a dramatic decline in public stocks being traded as more and more of these companies have been taken private. And at some point, you have to say, my gosh, are there too few public stocks for all these private equity firms, particularly now that the ratio is about 1-to-1, one private equity firm for every public stock out there. So yes, there is a concern about so many of these firms getting into this market. But one of the things I like to point out is here at Common Fund, we published a research article about 5 or 6 years ago. And no offense, Frank, I know you're the editor-in-chief of the Journal of Portfolio Management, but we published this article in the Journal of Alternative Investments. It seemed a better venue for it.
Yes, certainly was.
But in that article, we in fact identify the liquidity premium. Up to then, it was basically a finger in the wind, someone's best guess as to what it should be. And most guesses is that the liquidity premium, meaning the premium for investing in private equity over and above public equity, that premium was about 3%. Well, lo and behold, we discovered in our paper it was about 3.6 or 3.7%. So not too far off from the rule of thumb estimates that were out there. That was part one of the article, was just how do you identify the liquidity premium, and we show how to do that. The second thing we did in that article was to say, all right, let's find out if this liquidity premium is really a unique standalone risk premium. There's been a lot of suspicion that the liquidity premium is just a levered up public equity market risk premium. And what we discovered is indeed the liquidity premium is a standalone risk premium, different and distinct from the equity risk premium, which is the premium for public equity markets. It was different and distinct from the credit risk premium for investing in credit markets, different and distinct from duration risk premium. And then we threw also all the other French factors added, and indeed, it was different and distinct from all those factors. So point number one is the liquidity premium is real. Long-term average, and we looked at over the last 40 years, is about 3.6%. And that premium is different and distinct from the equity risk premium, duration, credit, and all the other French factors. So that's good to know. Now, where are we today? Where we are today at Common Fund, we still use our liquidity premium model to measure it on a quarter-by-quarter basis. And actually, liquidity premium is a little bit above 4% right now. So a little bit above its long-term average. What that tells us is, yes, there's still sufficient premium in the private capital markets to apply capital there. And we use that as one of our critical macroeconomic data points in our macro dashboard. Now, there's a catch. The equity risk premium, which is the premium for investing in public equities over treasury bonds, you can capture through an index fund or an ETF. There's a passive way to capture that equity risk premium. The same for duration and credit and the French factors. They're either index funds or ETFs that allow you to passively capture those risk premium. There is no passive way to capture the liquidity premium. There's no index fund out there or ETF out there that allows you to do that. So how do you earn it? You earn it by allocating your capital to private equity funds. That's the only way to capture it. And that means you have to take the liquidity risk from locking up your capital long term in order to earn that liquidity premium, and that's the catch. So yes, there are a lot of private equity firms out there, basically one for one now with publicly traded equity stocks. But the liquidity premium is real, and right now it's slightly above its long-term average. So we're still bullish on private capital right now.
How do you think about sizing private market allocations within a diversified portfolio, particularly given their illiquidity and the challenges of rebalancing just when you need to during market stress?
This is a great question. It's not only what are your risk and return objectives. When we sit down with a client from Common Fund, which again are either endowments or foundations, or we have a few high net worth investors, we're looking at, okay, what's your return objective? What's your risk tolerance? And actually, what's your liquidity budget? How much can you actually invest in private capital? Now, the most sophisticated clients at Common Fund have 50% or more of their overall portfolio allocated to private capital. And that's private equity, venture capital, real estate, private credit, et cetera. So when we sit down with an endowment or a foundation, one of the things we look at is what's their spending role? How much of the endowment or foundation are they spending on an average annual basis? So on the one hand, when we look at endowments and foundations, some have higher spending rules. They might be spending the rate of inflation plus 6%. So that'd be about an 8 to 8.5% spending rule. That's a pretty strong spending rule. And as a result of having a higher spending rule, they need to have more liquidity to be able to generate the cash flow to support that spending rule. On the other hand, with such a high spending rate, they need to invest in asset classes that can produce higher returns. And so you have a bit of a conflict there between needing more cash to meet their higher spending rate, but at the same time investing in asset classes that can generate higher returns to support the higher spending rate. And what we have run into in several cases at Common Fund are endowments and foundations that have the desire to take more risk and allocate more to illiquid asset classes, but they're limited by their spending rule. In other words, they have the appetite to invest in more illiquid assets, but not the ability because their spending rule is so high. And we try and balance, what are your cash flow needs on an average annual basis, and use that as one of the checks and balance for how much you can actually allocate to private capital.
Okay. Well, in private markets, the areas that seem to be growing are private credit and infrastructure. They've attracted significant inflows, from what I understand. Where do you see genuine opportunity versus potential overheating? And how do you separate sustainable themes from cyclical trends?
Let me focus on private credit for the moment. Private credit is not, is not a cyclical trend. It is one of the fastest growing parts of the private capital space. So if you think about it, about a decade ago, we used to call private credit, air quote, shadow banking. Because we had these firms that were doing banking, but they weren't really part of the banking system. And so it was shadow banking. It was some nefarious thing going on off in the shadows. Well, today, very different. Private credit is completely out of the shadows. It's into the sunlight, and it's a mainstream asset class. In fact, at Common Fund, we've been allocating to it as part of our strategic asset allocation for about 8 years now. So let's go back to why it's not a cyclical trend and why it is a sustainable theme. And that gets back to banks. Large and small banks have pulled away from their traditional business model, which was making and servicing loan. The traditional business model of a bank is they would make a loan to a corporation. They would take that loan and then put it on their balance sheet. And then they would service that loan, collect the interest from it, and that's part of how they would generate profits. The business model for the banking sector has changed dramatically, and it has shifted from loan origination and managing those loans to fee generation for other services. So banks now offer wealth management, custody fees, FedEx trading and clearing. It's more about capturing fees than it is collecting rent from a loan portfolio. And that trend's not going away. That's why this is not a cyclical trend. This is sustainable themes. Banks have pulled away and they continue to pull away from their traditional roots of making, owning, and servicing loans. So they created a void. The banks created this void. They were no longer lending, particularly to small and medium-sized enterprises. Well, that opened up a big void, a vacuum. And into that void, private credit has flourished. So private credit, definitely not a cyclical trend. This is a sustainable theme. It's going to be with us for the next generation or so, or continue. So that's one point I'd make. The second, when you think about private credit, at least when I think about it from an investor point of view, it's one of the few places in the financial markets where there's an arbitrage opportunity. Now, the term arbitrage gets thrown around a lot. The precise definition, Frank, as you and I know, is arbitrage means riskless profits, that you get something for nothing. More generally, what it means in the financial markets today is you get more than you should. And that's the case with private credit. So when you think about private credit, and right now I'm going to focus specifically on senior secured direct lending to small and medium-sized enterprises. When you look at private credit, so these senior secured loans of similar quality, credit quality to high yield bonds, these senior secured loans earn more. And that should not be the case. And why is that? Well, let's start with the fact that they're senior secured loans. They sit at the top of the capital structure. And they're earning more than high yield bonds of similar credit quality, which are at the bottom of the capital structure. Furthermore, high yield bonds are bonds. They have duration risk. Senior secured lending at the top of the capital structure do not have duration risk. These are floating rate bonds. They adjust. So senior secured floating rate debt should earn less than high yield bonds, which are at the bottom of the capital structure with a lot of duration risk, and yet they earn more. Therein lies the arbitrage. And that arbitrage has been in existence for a long time now, and it continues to exist. So that's one of the reasons why we remain bullish at Common Fund and private credit. We see that arbitrage, and while it continues to exist, we're going to continue to take advantage of it. The last thing I would talk about is, we're looking at other things at Common Fund in addition to senior secured lending. We're looking at things like litigation finance, litigating or financing just that, claims that are in court. Aircraft leasing is another, music royalties are another. So there's a lot of new ways to apply private credit nowadays.
Well, you've managed institutional portfolios through a good number of crises, from dot-com collapse and the global financial crisis to the pandemic and times of inflation and interest rate shocks. What lessons about risk management have stayed constant for you across the different environments?
Great question. The very first one I would start with is pay attention to economic fundamentals. So a few moments ago, I was talking about the equity risk premium. Let me just clarify what that is again. The equity risk premium is the return premium you get for investing in public equities over U.S. Treasury bonds. So equities are fundamentally more risky than Treasury bonds. So you should earn, over long periods of time, some risk premium for owning public stocks over Treasury bonds. And indeed, that's one of the things we measure at Common Fund. We've looked back again over the last 40, 50 years, and the long-term equity risk premium is about 4.1 or 4.2%. Again, that's what you should earn for investing in public equities over Treasury bonds. So a long time ago, at the height of the dot-com bubble, when I was working at CalPERS, I was asked by the CalPERS board, Mr. Anson, what do you make of these stock market valuations? And I responded honestly, I said, gosh, I don't know what to make of them. So I was asked by the board to do some analysis and come back to them to get some sense of, how we felt about it at CalPERS. And one of the things I did back then was, for the first time, was put together this equity risk premium calculation. And how do you do that? It's really just an IRR, or discount rate calculation. The way we do it is we forecast out the earnings to the S&P 500 going out the next 2 to 3 to 4 years. And then we figure out what's the discount rate that will discount those future earnings to the S&P 500 to today's current value that we see in the market. That gives us an IRR calculation. From that IRR calculation, we subtract out the yield on the 10-year Treasury bond, and what's left over is the equity risk premium. Again, long-term average, about 4.2%. Well, at the height of the dot-com bubble, that equity risk premium was 0. In other words, back then, the financial markets believed, we all believed, because we were all in the financial markets back then, that stocks, public stocks, were no more risky than bonds. And as a result, you didn't need to have a risk premium to own them. Now, that's crazy. The other fascinating thing is when I plotted the equity risk premium back then, I went back 30, 40 years. And there was one other time when the equity risk premium went down to zero. And that was in 1987, which, going back into the history books, that was the crash, the big stock market crash in October of 87. What was called Black Monday, Black October, whatever. And that's when the circuit breakers were instituted at the New York Stock Exchange and other stock exchanges. But what happened back then, there was something called portfolio insurance. And the market collectively believed that you could eliminate equity risk through portfolio insurance. Well, guess what? You couldn't. But for a period of time, everyone believed you could, and so the equity risk premium went down to zero. Again, stocks are no more risky than bonds. The U.S. stock market crashed. It corrected dramatically. It was really a horrible time to invest. And the equity risk premium shot back up. Well, same thing with the dot-com bubble. Equity risk premium went down to zero. The stock market bubble burst, and we went into a 3-year bear market in U.S. equities. 2000, 2001, 2002, we had double-digit declines in the U.S. equity market. So back to my CalPERS story, I presented this finding to the CalPERS board. I showed him the equity risk premium was at zero, that was crazy. And to the board's credit, they allowed me to underweight equities. That was against the grain back then, but credit CalPERS for having the courage, the fortitude, and just the common sense to say these things are way overvalued. We should cut back on our allocation until things sort themselves out. So that goes back to equity fundamentals. And that's one of the things that, again, I continue to look at throughout my career. I was talking earlier about Common Fund's macroeconomic dashboard. The liquidity premium is one of the data points we look at. We also look at the equity risk premium on a quarter-to-quarter basis. And just as a data point right now, the equity risk premium is at about 2.3%. Again, long-term average is 4.2, about 2.3 right now. That indicates stocks are overvalued compared to their long-term average.
Let's talk about resilience in a portfolio. How do you define and build resilience in a portfolio, making sure that it's not just for diversification, but also the ability to withstand liquidity shocks, policy shifts, unexpected tail risks, and unexpected tail risks when they close down ports or some country takes over your data center. How do you deal with that?
It's very hard. First, there is nothing, there is no portfolio that is shock proof. You can build a portfolio that's shock resistance, which gets back to resilience, that can withstand some of these shocks, whether they're political shocks or economic shocks. But there's nothing that's shock proof other than cash. And yes, you can just take all your assets and put them in cash, but guess what? If you do that, you're not going to be able to fund all the spending you need from your college endowment or from your foundation, or if you're a high net worth individual with retirement plans. Cash is not going to get you there. It might protect you for a short period of time, but it's not going to help you achieve your long-term financial goals. So you can build in shock absorbers that give you some resilience, but there's no portfolio out there that's shock-proof. So we have to accept that to begin with. So what are some of those shock absorbers? And those are things that generate a cash yield. Anything that can pay you, a dividend or a rent in the middle of a crisis is a good thing. So, people are like, oh, fixed income, that's so boring. Well, guess what? It provides a cash flow. It provides a cash yield. It's a shock absorber. As much as some of our clients say, gosh, do we still need fixed income? Yes, you still do. And it's still part of our traditional asset allocation. But it's more than that. We look at international stocks, which tend to have higher dividend yields than U.S. stocks. If you look at MSCI Europe, the dividend yield is about 3.5% to 4%, which is twice that of the U.S. So international stocks have a built-in shock absorber. They have higher cash yields, higher dividend yields than U.S. stocks. Direct lending, we were talking about that as part of private credit. That generates a cash flow every 6 months. And guess what? It also adjusts with inflation. That's a great shock absorber. Anything that has a cash associated, real estate provides real estate rents. Again, another great shock absorber. So the key point is you can't build a portfolio that's shock proof unless it's all cash. And if it's all cash, it's not going to help you achieve your long-term financial goals. But you can build in things that are shock absorbers, and those things tend to have some cash yield or cash component associated with them. The flip side of resilience is disruption. ChatGPT is very disruptive. AI is very disruptive. How do you build that in? How do you go along disruption? And we do that through our venture capital program, which is where we get access to companies like ChatGPT and others. So not only are we thinking about resilience, we're thinking about disruption, and we want to make disruption work for us. And so we're looking for ways to build disruption into our portfolio.
Let me turn to risk management. To what degree do you view governance and decision-making structures as part of risk management? And how can, importantly, investment committees or boards strengthen their ability to respond under stress?
This is a great question because it is often overlooked, frequently overlooked. Good governance leads to a well-functioning portfolio. At Common Fund, we call this dividing up the trade tickets. So what do I mean by that? Well, I started my career on the trading desks on Wall Street, Salomon Brothers back in the day. And what I mean by that is, when you submitted a trade, you put your name on that trade ticket. There's no place to hide. If that trade does well, you get all the benefits and accolades from it. But if that trade goes south and it loses money, again, there's no place to hide. Your butt is on the line because your name's on that trade ticket. It really gets down to accountability and responsibility. So when we sit down with a new client, a new endowment or foundation, that's what we do. We talk about, first thing we're going to talk about is investment governance and dividing up these trade tickets and making very clear who owns what. So for an endowment or foundation, what we work with the board of trustees that manages that endowment or foundation, we make it clear to them, you own the strategic asset allocation because you're the ones who are setting your overall return targets, and you're the best ones to measure what your risk tolerance is. Now, we help them through that process at Common Fund. So they set about putting together the strategic asset allocation with input from us, but that's the trade ticket they own. The flip side is over on the Common Fund side of the table is then we backfill that strategic asset allocation by finding good direct investments and good managers to round out all the asset classes, real estate, private equity, private credit, stocks, bonds, etc. And so we own those trade tickets, and that's what we're held accountable to. But having that governance set up at the very outset is critical to a well-functioning portfolio going forward. And then you're talking about, how do you respond in times of stress? Several years ago, and we started doing this right before COVID, and you could say, gosh, Mark, brilliant thought, just good timing. We're just lucky. We built into our client portfolios what we call the crisis playbook. And so all of our clients have the crisis playbook. Again, we implemented this like 12 months before COVID. And the idea of the crisis playbook is threefold. First, stay calm. You've got a crisis playbook to walk through when this crisis hits. The second, by working through your crisis playbook, is understand where are your pools of liquidity that you may need in periods of stress. And then the third part of the crisis playbook is to look at the crisis. Is it a threat or an opportunity? For some of our clients, it is more of a threat because they have very high spending rules or might have been stretched. But for some of our clients that have conservative spending rules, when COVID came around, they're like, gosh, should we be taking advantage of this? And indeed, several of them did. When valuations across the markets declined quickly, they were ready to step in and provide liquidity to those who wanted to exit, and they made very good returns. So again, governance, divide up those trade tickets at the very outset of the relationship, and then build a crisis playbook so that you're ready for those moments of stress.
Well, let's talk about the new analytics for us. The rise of new tools from big data and advanced analytics, AI, they're reshaping how institutions source opportunities, how they manage risk, and how they service clients, actually. How do you see technology changing the practice of investment management at the institutional level? Okay. And in particular, what role do you think AI and machine learning can realistically play in investment decision making, and where do you see the limits of these tools?
Well, so far we haven't seen any limits, so we'll start with that. Sky's the limit. Let's put it that way. Let's start with how do we look at AI from an investor point of view? So, our goal at Common Fund is to build robust portfolios for our clients. This is clearly an investment opportunity. How do we take advantage of it on behalf of our clients? I talk about the demography of artificial intelligence. And when we hear the term demography, we tend to think of population trends, growth trends. It's typically tied to the growth of society. But the fact is, when we think of artificial intelligence, it has already is having such a dramatic and wide-ranging potential to impact the well-being of every person on the planet. So I think it's accurate to call it a demographic trend, a long-term trend tied to our population growth and how we apply it and how it's going to impact our lives going forward. So let's get back to how do you think about it as an investment theme? Well, first principles is invest directly in those new AI leaders. I've mentioned a few of them already: ChatGPT, Anthropic, Hugging Face, Mistral. We're making direct investments in those companies today, and we think there's plenty of room for all those companies to succeed. So, those are the initial platforms for AI. Let's get a piece of that action. Let's make certain that we've got that covered for our clients. So that's first principle. Who are the companies right now that are directly driving AI? It's basically those four, maybe a couple others, and those are the ones with whom we invest. Second principle. Okay, you got all this AI stuff out there. How's it actually supported? Well, you need data centers, server farms, massive server farms to churn through all this data. And so we've been investing in data centers now for about 8 years at Common Fund. And again, you like to say, oh gosh, brilliant idea that you saw artificial intelligence 8 years ago. Actually, we didn't, but we did see the growth of technology and the demand for big data and the just beginning of large language models. And so we began to incorporate data centers as a key component of our real estate portfolios. Nowadays, it's about 20% of our real estate portfolios. So it's a very large investment component. And so that's the second principle, is invest in all these server farms that support the churning of AI. Third principle is, right, what do you build from there? Well, all these data centers are going to need energy to drive them. These are energy intensive data centers, not only to drive the servers, but they have to have huge air conditioning units, what are called chillers, to keep the temperature low because heat is resistance. And so you need to keep these server farms in an area of 60 to 65 degrees. So a lot of energy consumption goes into the server farms, which goes into support AI. So we have been supporting that. In fact, just recently, we committed capital at Common Fund to a private power generating fund. And what this fund does is they buy companies or help build companies that build private energy generation for data centers. So these are kind of like mini utilities, privately owned, that are building energy sources to drive server farms or data centers. So again, first principle, directly in the AI leaders today. Second principle, they're going to need data centers to generate all the AI. Third principle, you're going to need power to support the data centers. So let me stop there. That's just on an investment theme basis, how we're looking at artificial intelligence.
Well, many organizations now are struggling. Well, they're actually not struggling, from what I understand, with using the new technology, but they're having problems embedding it into their daily processes. Uh, you may be facing that issue. What have you found to be the biggest challenge in implementation of the new technology, and in general, how can CIOs overcome that challenge?
Well, the first is there are no best practices to using artificial intelligence right now. It's just too new. We're all trying to learn it. So that's problem number one. You're like, okay, best practices should be this. Let's go down the checklist. That checklist doesn't exist. So that's one. Second problem is consistency of use. There are several AI platforms out there. We've talked about them: ChatGPT, Anthropic, Copilot, Mistral, none of them, well, excuse me, each of them has a different protocol as to how you use them. So there's no common protocol. So if you're using ChatGPT one day and Anthropic another, well, you have to use different protocols to use them, which gets down to fluency of AI communication. Each of these platforms has their own way, their own unique way of interacting with the artificial intelligence. And it takes time to learn the nuances of artificial intelligence searches and applications, depending on which platform. Now, you get better the more you use it, but it's a lot of trial and error. Okay, I need to refine my question this way this time, or I had too many words, or I misspelled a word here and it didn't recognize it, or I was using a word and it took that word but said, oh, maybe that's not what you meant, and tried to reinterpret it for me. So getting to use these AI platforms just takes time and effort and trial and error, and that builds your own fluency. But again, you need to build fluency for each one of these platforms because each of them is different. Then there aren't many formal training programs yet for AI. There are a few out there. I'm sure there's going to be a lot more in the next couple of years. But if you're training your staff, it would be nice to have a consistent AI training platform that everyone says, oh, yeah, okay, let's go through this. And we now all understand how to use it. Another big issue, and this is a risk for businesses, is security of confidential information. Well, if you use some client confidential information and you crank it through one of these AI platforms, you've effectively released that private information, that confidential information to the web. And that's a big problem. Not only are you going to have a very angry client on your hands, you might have a very concerned SEC knocking on your door. And that gets back to the last point, which at some point, I'm sure the Securities and Exchange Commission will come out with some rules or regulations about how asset managers and broker-dealers, et cetera, are supposed to use artificial intelligence as it applies to their client accounts. Right now, those rules don't exist, so we're all trying to figure it out ourselves. But one of the key practices that at least we use at Common Fund is you are not allowed to use client data in an AI platform, because that's the same thing as just releasing it to the web, and we can't allow that.
Okay, well, now, given your background, you've worked at the intersection of investment management, governance, leadership for how many years have you been in the industry?
Gosh, about 25 now.
Okay, 25 years. So looking back, what advice would you give the next generation of portfolio managers and CIOs?
First, never stop learning. Look at artificial intelligence. We're all still learning that. And 5 years from now, there'll be something new to learn. So, I make the joke, once you stop learning, then it's time to retire. But never close off your brain to learning something new. Uh,
In
something
your,
else.
oh, I'm sorry. Go ahead.
Okay. I'd always say, always seek to improve yourself. I hold both the CFA designation and the CAI designation. Now, the fascinating thing is when I first heard about the CFA designation, I was at Columbia Business School getting my PhD. And back then I thought, you know what, I'm getting my PhD. Well, what's the CFA thing? I don't need that. Well, okay, big mistake. I found out years later, once I got in the asset management industry, that the CFA thing was a pretty big deal, and I didn't have it. So I had to go back and backfill it and work through it at that point. So I had to learn from my own mistakes. So get those credentials. They're not easy to get. They will enhance your understanding of the financial markets. They will improve your standing within the asset management industry. And then once you get those degrees, get active and stay active in the societies that support them, the CFA Institute, the CAI Institute, et cetera. Volunteer. Give additional time. Something else I would recommend, and Frank, this is one that'll resonate with you, is publish. It's not easy. It's not easy to write a paper. It takes concentrated effort. And guess what? Your boss will probably not ask you to do it. And you probably won't even get a bonus for doing it. But taking the time, making the effort to write an intelligent research article on some pragmatic portfolio problem is one way to build your resume and your reputation. Publishing is also a good way to test your ideas across the asset management industry. And it's been kind of neat over the years. I've had someone's like, oh, Mark, I read that paper. That was actually an interesting idea. The flip side is I can remember publishing a paper, and Frank, you'll get a kick out of this, in front of an organization called the Q Group, Quantitative Group of Finance. And typically there might be 3 or 4 Nobel laureates in the audience, and I was presenting a paper, and I got immediately dressed down by a Nobel laureate who was in the audience at the time saying, Mark, you got that all wrong. And he just took me through it, in front of everyone while I'm on the stage. So that can be painful, but it was also a great learning experience. And in fact, I did kind of publish that paper, taking those comments into account from that Nobel laureate, and it made for a much better paper. And it helped again, got me to learn more. So continue to publish. If you get a chance to speak at industry conferences, do that. Now, it's not easy. It takes time. You have to prepare for it. You're not going to get any extra amount in your bonus. Your boss is probably not going to ask you to do it. But those are good ways to develop your skill set, to establish your reputation, and just to network within the industry. So never stop learning. Publish if you can. Join your local societies, professional societies, and absolutely, when you're asked to speak at an industry conference, say you'll do it.
Mark, it's not just publishing research. To give back to the industry, more and more I've been turning to interviews that I publish in the journal Portfolio Management. There you get incredible insights into what's going on in the real world. One
Yep.
of the major complaints of students at universities is that there's a huge gap between what's textbook taught in courses and what practitioners have to offer. Okay, they don't have to publish in the top academic journals to provide great insights to people who are moving into the profession. So now this might be a tough one. In your experience, what qualities distinguish the best institutional investors from those that are merely competent?
Well, humility. Let's face it, the financial markets are going to hand you your butt. They do that to everyone. Sooner or later, you're going to have a bad investment. You'll make a mistake. We all do. So first, get over yourself. You're going to make the mistake. Don't go, oh my God, I made a mistake. What do I do now? Learn from it. So admit it, learn from it, and then apply it. Next time, don't make the mistake. Figure out what you did wrong and then apply that in your next investment decision. But mostly get over yourself, okay? We all make mistakes. It's not that big a deal. You will survive. We'll move forward. So I think good investors have thicker skin, but they're also honest and humble enough to admit, hey, yeah, I got that one wrong. Just like when the Nobel laureate was dressing me down at the Q Group. I was like, oh, yeah, I guess I didn't really think of that. Might have been a fun moment at the time, but it made me a better investor and led to publishing a better paper. Good investors also question their assumptions. That could mean reviewing your strategic asset allocation for a portfolio. It could mean reviewing what are your expectations for generating alpha or skill from an asset class. It could mean, revising what you think is the long-term liquidity premium for investing in private capital. But continually revise your assumptions. Never consider those to be locked in or chiseled into granite. They will change over time, and you need to change with them. Also, good investors have a discipline for making investment decisions. Does your firm have an internal investment committee? How are divergent views within that organization blended into the overall portfolio construction process? How do you measure and monitor risk? When do you decide to overweight or underweight a sector or an asset class or a stock or a bond? And then last, what's your sell discipline? When do you decide it's time to get out? It's great when you make a good investment call and you got in and something's now gone up in value, but at some point you need to exit to crystallize that value. How and when do you do that? So again, I think, good investors are humble. When they make mistakes, they learn from it. They get over themselves. They question their assumptions, and they have a good discipline surrounding their thought process.
Okay. Last question. Looking ahead, what are the biggest challenges and opportunities that will shape the future of institutional investing over the next decade?
Well, I'm going to come back to artificial intelligence. Yes, I understand it's very popular and current topic, but it will change and challenge how we think about investing. And so I'm going to give the example of myself. AI turns traditional financial modeling on its head. So when I went to Columbia University in New York City to get my doctorate, when I was looking at my PhD model, the way I was trained in classical economics, so my PhD was in financial economics, was you would first build an equilibrium model to identify factors that would explain how stock prices should react to new information. From that equilibrium model, you would then extract some testable hypotheses that you could then build into a computer program. From those hypotheses, you would then construct that computer program, that empirical paradigm based on the predictive factors to test those hypotheses using econometric techniques, again, in some computer program. Then you would review the data and draw your conclusions from that econometric analysis applied to your hypotheses. And you would then conclude, did your factors influence or not influence stock price behavior? When you think about all of that, what that really was, still is, a predictive model. My PhD dissertation and so many others like them were meant to identify economic factors that would attempt to predict how stock prices would react to new information. AI flips that completely on its head. AI is not worried about some equilibrium model. It's not trying to predict. Instead, it describes. It's not building testable hypotheses. What it does is it scours whatever data that it's fed into it to detect patterns of movement. This could be stock price movements or patterns. It could be consumer behavior. It could even be traffic patterns during rush hour. But as AI continues to move forward, it may render these predictive models obsolete. With regard to artificial intelligence, only the data matters, not some equilibrium model. So let me build on this. This gets to one more challenge. It's the challenge of what I call discretion versus description. Discretion is what I apply now and what most asset managers apply now. Discretion requires human judgment. It requires intervention, while AI instead is just describing patterns. AI does not rely on judgment. It simply describes. So are we as asset managers willing to let go of our judgment based on our many experiences, the things we've done wrong and what we've learned from it, for an investment process that does not rely on history, does not rely on experience, does not rely on academic training? I'll tell you what, it's going to be really hard to let go. Certainly it will be for me. So that's one of the philosophical challenges I see with AI, challenging the established way of thinking about how the asset and management industry works and how financial markets work.
Mark, please note on your calendar, 18 months from now, we're going to go to Conversations with Frank Fabozzi, round 3. Okay?
Got it.
And I do appreciate your taking the time to do this. I'm sure everyone who's listening has learned a great deal. So listen, thank you very much, and keep sending me articles, please. When we look at the downloaded articles in the journal, the publisher keeps that. You're always one of the most heavily downloaded ones. Okay.
Keep that in mind.
And
Nice to know. Thank you for saying that.
Yeah. Well, listen, thank you very much. Let me let you get back to making money for your clients.
Much appreciated, Frank. Be well.
Take care.